Super microcomputer, Nasdaq, SMCI, that once skyrocketing star of the AI server world, just hit the financial turbulence beacon. On April 29, SMCI dropped its preliminary fiscal Q3, ending March 2025, numbers in the middle of Wall Street, and the news was ugly. Instead of the fireworks investors expected, SMCI delivered a damp squib. It now projects $4.5 to $4.6 billion in Q3 revenue, down sharply from its own guidance of $5 to $6 billion. Adding insult to injury, SMCI warned that gross margin would slip by about 220 basis points, i.e. 2.2 percentage points, from Q2 to Q3. Management explained this was due to hefty inventory write-downs on older gear and one-off rush costs to get brand-new AI servers out the door faster. In other words, they stocked up on old tech that devalued and burned extra cash promoting shiny new products. This margin hit means less profit per sale, which in a thinly margined server business is a big deal. More on that soon. Investors watched this bombshell unfold with jaws on the floor. Shares of SMCI immediately turned south. As the news broke on Wednesday, the stock plunged 11.5% in one day. In after-hours trading it was down as much as 19%, and by the next day's close it had sealed an 11.5% loss. To put it into perspective, that wipeout erased billions in market value almost instantly. What just happened? Why the Q3 miss shocked everyone. Imagine planning a big barbecue with 60 friends, guidance, 5, 6B burgers, then showing up with supplies for only 45 to 50 friends, actuals, 4.5, 4.6B. People would be upset, right? That's basically what SMCI's leadership did with Wall Street. They slashed guidance overnight, blaming a few hyperscaler customers for delaying or rescheduling their server orders into the next quarter. The company insisted this was just a timing issue, that orders aren't cancelled, just bumped to later. But analysts and investors were not buying it without a fight. The stock takes a dive. What 11.5% down means. When a stock plunges 11.5% on big news, it's Wall Street's way of saying, whoa, that was worse than we thought. Traders react swiftly. In SMCI's case, the hammering was merciless. Aside from the 11.5% drop on Wednesday, by after hours it had tanked nearly 20% before rebounding slightly by Thursday's close. In plain terms, a lot of investors got hurt, and some traders made short-term gains, as stop-loss orders tripped and panic selling set in. But there's more context. Even before this week's drop, SMCI had been struggling with its stock price. The company had a messy period, a short seller report last year, delayed SEC filings, and auditor shakeups. Ask a previous auditor about that. All that combined to scare investors. So when this guidance cut came, it felt like piling on. The 11.5% drop was just the latest in a series of gut punches. On the bright side, a big drop can bring valuation down to interesting levels. Some value investors might be wondering, is the market overreacting? Has SMCI become a cheap AI play? That optimism is why we saw a little bounce last week. More on that soon. But caution reigns. When a ride has slid this far, it usually does so because something fundamental might have changed. Wall Street's consensus is now a cautious hold, reflecting uncertainty. By the way, if you are benefiting from the content so far and want more like this, like the video, it means much to me, or hit the subscribe button and comment the word more. Just go ahead and type the word more so I know. Now that you have commented, let's continue. Margin meltdown, why the 220 basis point drop is a big deal. Let's break down that 220 basis point, BPS, margin hit, because it's a headline all its own. A basis point is just 1/100th of a percentage point, so 220 BPS equals 2.2%. If your profit margin was 10%, it's now about 7.8%. Why should a casual investor care? Gross margin is the core profitability metric on each server SMCI sells. It's the slice of each sale that gets counted as profit, after direct costs. If margins drop, it means either costs went up, sales prices fell, or both. And that eats directly into earnings. SMCI specifically said its gross margin for Q3 would be about 2.2% lower than Q2, net of those write-downs and rush expenses. That's a real bite. In serverland, even a single percentage point swing can make quarterly profits swing tens of millions of dollars. Here's the crux: those write-downs and extra costs weren't part of the base business, they're one-time hits. But they signal two worries. First, SMCI had to do inventory write-downs on older generation products. This implies they overestimated demand for older servers, or their customers switched to newer tech. Those servers became outdated or less needed, forcing SMCI to reduce the recorded value of that inventory. It's like realizing those burgers you stocked up for the barbecue went stale, you lose money. So, SMCI took a markdown. Second, expedited costs to get new products to market suggest they were in a hurry to roll out the latest AI servers. Maybe they felt competitive pressure, NVIDIA's Blackwell chips, AMD, or rivals like Dell/HP. Rushing production, expedited shipping, overtime, inefficient production runs, costs extra. Those costs, while intended to boost future sales, hit margins short-term. Put it this way, profit margin is like the headroom in a tight airplane cabin. A 2.2% slide is like the cabin suddenly losing a couple inches of height, suddenly everyone's bumping their heads on the ceiling. For investors, that margin erosion means SMCI's profitability is more vulnerable. It feeds the worry that in a tougher market, SMCI can't protect its profits. That's why analysts flagged it hard. And keep an eye on competitor dynamics. SMCI said some customers are shifting from older GPUs, like NVIDIA's Hopper, to new ones, Blackwell. That transition itself could cause delays and mismatched inventory. If a big client says, "Wait for the shiny new toy," SMCI has older stock stuck. Also, if larger hyperscalers, Microsoft, Amazon, are pacing their AI server buys more cautiously, all suppliers will feel it. SMCI's margin slide suggests it's not immune. Stargate, $500 billion for AI infrastructure, and where SMCI fits in. Now let's pivot from the gloom to some sci-fi level talk. Enter Project Stargate, not a movie, but the latest blockbuster AI infrastructure plan. In January 2025, OpenAI, yes, the ChatGPT people, announced a new JV called Stargate to invest a mind-blowing $500 billion over 4 years into American AI data center infrastructure. That includes building massive new server farms, the first one is already under construction in Texas, and deploying $100 billion immediately. It's billed as a national-scale push. SoftBank and OpenAI lead the effort, with Oracle, NVIDIA, Microsoft, via Azure, and others as partners. Why does this matter for SMCI? Well, SMCI makes many of the specialized servers that AI projects like Stargate need. High-density, high-powered machines with liquid cooling and all that. Think of SMCI as one of the top builders of AI computer muscle cars. If you're building a $500 billion AI highway, you're gonna need a lot of those engine blocks. Amid the chaos, Wall Street analysts have been updating their views. One widely followed analyst is Samik Chatterjee at JP Morgan. On April 30th, he trimmed his price target for SMCI from $39 to $36 and kept a neutral rating on the stock. What does all that mean for us mere mortals? First, price target, it's an analyst's estimate of where the stock should trade in 12 months. Chatterjee lowering it to $36 suggests he sees less upside now that guidance was cut. But it's also only about a 17% bump from where SMCI was trading, $30-ish. In other words, JP Morgan thinks the stock could slightly rise, but nowhere near the old highs. Second, the neutral rating. This is investor speak for, this stock is expected to perform roughly in line with the market or peers. It's neither a strong buy nor a sell. In practical terms, it means JP Morgan doesn't think SMCI is a screaming buy at current prices, but they're not saying, dump it, either. Given all the uncertainties, cool down in demand, margin pressure, waiting for confirmation of the guidance, excuse, they're basically saying, we'll watch and see. Dig into Chatterjee's reasoning, via the Investing.com article. He noted that the Q3 miss seemed driven by specific customer timing, not a broad demand crash. He's basically saying, hey, this might be a one-off shift rather than AI demand dying. So he isn't fretting about the whole industry right now. He also thinks some of those margin pressures, inventory markdowns on older GPUs, etc., will be temporary. All that is moderately reassuring. But because visibility into 2025 is low, he trimmed his fourth quarter forecasts and so cut the target price. Fear God, and give glory to him, for the hour of his judgment is come, and worship him that made heaven, and earth, and the sea, and the fountains of waters. Revelation 14 verse 7. I appeal to you to fear God and obey his law. For his commandments are sure and his word everlasting. Do not be afraid, do not be discouraged. Want more information? Please check the description section. That's the end for now. If you have watched until the end, drop a comment like this, I stayed until the end. Just comment that I stayed until the end. When I see this comment, I will give you a heart. 3 more favors I request from you. First, like this video, subscribe and then turn on the notifications bell. If you do this, you greatly encourage me to continue bringing to you insightful information. Do not miss out on our future videos full of insight, all I am asking is your subscription. Thanks for joining us today, your support means so much to us. Do not hesitate to share this video to help someone who may benefit. I recommend that you watch the next video, subscribe to the channel and share your thoughts about today's video. Wish you God's blessings and care. Wait, watch and pray. See you in the next video according to God's will.